The US just pulled a bold move ordering global banks to cut ties with China. Headlines are calling it economic warfare, but what if they're missing the bigger picture? What if this aggressive trade crackdown is actually the spark that sets off a powerful bull run in US markets? In this video, we'll break down what's really happening behind the scenes, why this could be a major tailwind for American companies, and how smart investors are already positioning themselves to ride the wave. If you think this is just about China, think again. This is about the future of global money flow, and it could be one of the biggest investment shifts of the decade. Stick around because what looks like chaos might just be opportunity in disguise. Before we dive in, please take a second to hit the like button, share it with your friends, and also subscribe. Please help this video get at least 500 likes. It really helps support the channel and keeps us bringing you the latest market insight. Thank you. Just when you thought the trade tensions couldn't get any hotter, here we go again. Apparently the trade war wasn't dramatic enough. Now Washington is setting its sights on China's banking system. Yeah, it's bold and risky. We're diving back into the classic playbook, financial sanctions. But here's the thing. How much pressure can the global system take before something breaks? Are we steering towards strategy, or just lighting a match in a room full of gasoline? About a month ago, the US doubled down on its strategy to squeeze Iran's economy, this time through oil sanctions. But it's not just Iran in the crosshairs. Here's the real move. Any country that buys oil from Iran could now lose access to the US market. That means no trade, no deals, nothing. It's not just a tariff, it's a full-on economic wall. And let's be real, the big target here is China. Why? Because over 90% of Iran's oil ends up in Beijing. Sure, China can look to Russia or Saudi Arabia, but Iranian oil is cheap, strategic, and tied to a massive investment agreement from 2021. It's not so easy to walk away. So, while this looks like pressure on Iran, it's really a power move in the US-China chess game, and the next few steps could reshape global trade. Under a major energy for investment deal, China agreed to pour billions into Iran's economy. In return, they'd lock in a long-term supply of heavily discounted oil. 12% off market rates, plus another 6 to 8% for taking the political risk. That's a huge win for Beijing, especially with Iran locked out of much of the global system. Even more strategic, the oil is paid for in Chinese yuan, not US dollars. That's another step toward de-dollarizing China's global trade and reducing their dependence on the US financial system. From Washington's view, this isn't just about Iran, it's a pressure point on China. By cutting off Iran's oil, the US hits China where it hurts. Energy supply and trade leverage. Raise the cost of fuel and you raise the cost of everything coming out of China's factories. What's more, Trump is reportedly prepared to go further than anyone before, targeting Chinese banks if that's what it takes to shut this oil channel down. Even Janet Yellen wouldn't touch that line, which shows how serious and risky this strategy has become. In April, US Treasury officials quietly met with major banks in Hong Kong, and the message was clear: stop helping China buy oil from Iran. These aren't small players either. These are globally recognized banks with serious exposure to the US financial system. The warning? If they keep processing these oil deals, they could face US sanctions, and that could be devastating. Getting cut off from the dollar system would cripple their global operations overnight. At the same time, Trump is reportedly open to negotiating with Iran, possibly trading sanctions relief for a rollback of its nuclear program. Will that deal happen? No one knows for sure, but the pressure is building. Here's what matters. Banks are the lifeblood of the oil trade. They handle financing, insurance, and hedging. Without their support, moving oil across borders becomes incredibly risky, if not impossible. So, when the US leans on banks instead of oil tankers, it's not just a warning. It's a strategy to shut the whole system down from the inside out. US officials are now asking Hong Kong banks to do more than just follow the rules. They want them to dig deep. These banks are being pushed to investigate shell companies, trace ownership, and flag any suspicious oil-related deals, even those done in currencies other than the dollar. In short, Washington wants the banks to act as financial watchdogs to help enforce US sanctions and hand over the names of companies involved in buying Iranian oil. That's a bold request, especially for banks operating outside US jurisdiction. But here's where it gets even more interesting. While the US is turning up the pressure, Hong Kong is quickly positioning itself as a global financial heavyweight. It's hosting some of the world's biggest IPOs, including the much-anticipated CL listing, expected to be the largest of 2025. So, the stakes are high. These banks are being squeezed between U.S. demands and their growing ambitions to compete with Wall Street. How they respond could shape not just the future of sanctions enforcement, but the balance of power in global finance. It's no surprise that U.S. lawmakers are now calling out Hong Kong as a rising hub for financial crime. It's a serious accusation, and signals how tense things are getting. A congressional committee recently claimed that Hong Kong is helping China buy Iranian oil under the radar and even assisting in Russia's gold trade. Whether or not it's true, it shows how fast U.S.-China financial ties are starting to unravel. We're now looking at a likely decoupling between Wall Street and Hong Kong, something that once seemed unthinkable. But it's happening faster than anyone expected. And Trump? He's not backing down. He's still pushing the narrative that China is exploiting U.S. trade, repeating those same claims in a recent speech in Doha. With that mindset, nothing is off the table. Sanctions, restrictions, financial cutoffs, everything is now fair game in this economic power struggle.
It's just pay off debt. We're making a lot of money. We had a situation 6 months ago. We were losing $5 billion a day on trade. Now we're making money on trade. Don't forget, we were losing $1 trillion to China. So we essentially went cold turkey with China for a period of a month. Therefore, we weren't losing $1 trillion. I think that's pretty simple, Scott, right? Scott did a great job over there. They made a deal. They have great relationships with China.
If you're in China right now, one thing is crystal clear. It's time to speed up the push to de-dollarize. The message from the U.S. is loud and clear. Relying on the dollar and especially on systems like SWIFT comes with huge risks. All it takes is one policy shift in Washington, and suddenly your banks are frozen out, your transactions are flagged, and your economy gets squeezed. That's why Beijing is doubling down on building an alternative financial network, using the Yuan for global trade, signing bilateral deals outside of SWIFT, and promoting the use of digital currencies like the ECNY. The goal? Reduce dependence on the US dollar as fast as possible. Because in today's climate, dollar dominance isn't just a financial issue, it's a geopolitical weapon. For China, cutting reliance on dollar-based systems isn't just smart strategy anymore. It's a matter of national security. Beijing's push to use the yuan for international trade is gaining serious momentum, and the numbers don't lie. In March alone, China handled $725 billion in cross-border trade, and over half of that, about 54%, was settled in its own currency, the RMB. Compare that to just 41% in US dollars. That's a major shift in global trade habits, and it's only picking up speed. Ironically, the U.S. trade war is fueling this trend. Sanctions, tariffs, and financial restrictions are pushing China to find alternatives, and fast. If you're Trump or any U.S. policymaker trying to protect the dollar's dominance, this should be a wake-up call. High tariffs might sound tough, but they're actually encouraging China to cut America out of the equation entirely. The more the U.S. closes trade doors, the more China opens new ones elsewhere, building partnerships, boosting yuan-based trade, and slowly chipping away at the dollar's global grip. There's growing speculation that the China tariffs might not even last through the end of 2025. If that turns out to be true, it could trigger a massive shakeup in trade volumes. Less trade between the U.S. and China doesn't just mean fewer shipments, it also means fewer transactions in U.S. dollars. And that's a big deal. Chinese exporters are more than ready to switch to RMB payments, especially since it shields them from currency risk. Here's where the contradiction shows up. While the Trump administration talks tough on trade, free trade has actually been one of the strongest tools for supporting the dollar's global role. By pulling back from it, you don't just isolate China, you risk weakening the dollar's foundation, and things could get even more complicated. Remember Trump's push to reshore American manufacturing? That vision could take a serious hit if his new proposal, yes, the one he's calling the One Big Beautiful Bill, ends up passing. Even U.S. Trade Representative Catherine Tai and officials like Bassett are scrambling to get support for it. But critics say the bill might undermine the very supply chains the U.S. is trying to rebuild. It's a classic case of short-term politics versus long-term economic strategy.
Are you familiar with what President Trump has called his One Big Beautiful Bill?
Yes, sir.
Could you describe the basics of that bill?
It is a combination. The core of that bill is to make the 2017 Tax Cuts and Jobs Act permanent.
If this, what he quotes, a big, beautiful bill passes, will the deficit go up or will the deficit go down?
I believe over time, the deficit to GDP, which is the important number, agrees with that, will stabilize and go down.
From China's perspective, the urgency to break free from the US dollar has never been clearer. Relying on SWIFT, the global dollar-based payment system now looks more like a liability than a safety net. Every new US sanction or financial threat just reinforces one thing: the less China depends on the dollar, the better. America's escalating trade war is pushing China to expand new markets and double down on currency independence. Ironically, Trump's tough tariffs, some as high as 30%, may be accelerating the very thing Washington fears most: the rise of a parallel financial system that sidelines the dollar. If protecting dollar dominance is the goal, cutting off trade might be the wrong move. Free trade with China, for all its political baggage, has historically helped anchor the dollar at the center of global commerce. But as the two powers drift further apart, China is finding ways to trade, grow, and invest without ever needing to touch the greenback. There's growing speculation that the tariffs on China may not last beyond late 2025. If that happens, we could see a significant drop in trade between the two countries. Less trade means fewer transactions done in US dollars. Chinese exporters would gladly switch to invoicing and paying in their own currency, the RMB, eliminating currency risk for themselves. This reveals a major contradiction within the Trump administration's approach. While tariffs aim to protect American interests, free trade has historically been one of the strongest pillars supporting the US dollar's global dominance. Undermining trade with China could actually weaken the dollar. But could things get even more complicated? Possibly. Remember Trump's agenda to reshore industries and rebuild America's manufacturing base? That plan could be seriously jeopardized if his new legislative proposal, dubbed the One Big Beautiful Bill, passes. Even officials like Bassett are working hard to convince Congress to back it, but critics worry it might backfire and hurt the very supply chains the U.S. wants to strengthen. Well, it looks like things didn't go as planned. The bill is now stuck in limbo after losing a 21-6 vote. This legislation wasn't just about spending more. It threatened to hike taxes on certain income groups and increase the federal deficit. But the real red flag is a vague but powerful provision that could seriously damage Trump's own reshoring strategy. The bill would let the U.S. retaliate against what it calls unfair foreign taxes, but the language is so broad, it basically gives Trump the authority to slap higher taxes on foreign companies and individuals whose countries tax American businesses in ways the U.S. sees as unfair. That raises big questions. How high could these taxes go? Would American companies end up paying different rates based on where their foreign partners or owners are from? It's a confusing and risky path. Even worse, this punishment approach could backfire spectacularly. Instead of encouraging companies to bring manufacturing back to the U.S., it could push foreign investors away, adding to challenges like high labor costs and expensive materials. The proposed changes could hike the tax rate on U.S. income earned by foreign companies by a full 5 percentage points. For companies pulling in millions or even billions, that's a huge hit to their bottom line. Plus, some payments made overseas might see their tax rates jump from 10% to 12.5%. This feels a lot like capital controls designed to keep money inside the U.S. It raises a big question: does this really make the U.S. economy more attractive? Honestly, probably not. Imagine you own a factory in China or Japan. Would you rush to move production back to the U.S. when these tax policies keep changing? You'd have no idea if Trump might reverse course, or if the new administration after midterms would change everything again. And things could get even more unpredictable with the latest provisions being discussed. They might make the whole situation even worse. We have to be realistic. U.S. consumers aren't exactly booming with spending power right now. So what incentive do foreign investors really have to bet big on American manufacturing under these uncertain conditions? U.S. consumer sentiment has dropped to the second lowest point ever recorded, signaling growing worries about the economy. At the same time, inflation expectations over the next year have surged to levels not seen since 1981, a clear sign that people expect prices to keep rising. The whole reshoring idea was based on one key belief: American consumers spend more than anyone else, so building factories here would lead to quick returns and strong profits. That's the story Trump has been selling, but reality is catching up fast. The tariffs are starting to take a toll, and the rush to stock up in March and April has made things even more uncertain for shoppers. Even Trump's recent attempt at a truce with China hasn't been enough to calm nerves or revive consumer confidence. The U.S. economy faces serious headwinds, and that's bad news for the reshoring plan. Fear is running high, and that's why consumer sentiment keeps crashing. Even long-term inflation expectations from 5 to 10 years out have nearly doubled recently, hitting around 4.6%. That spells trouble for many companies. If U.S. consumer demand stays weak and it's the main source of revenue for many businesses, exporting to other countries won't be enough to fill the gap. Whether you're a small business or a big corporation in the U.S., you're going to feel the pinch. People will spend less, or you'll have to swallow the costs from higher tariffs and more expensive materials. It's a tough situation with no easy way out, just one big challenge after another. This one chart really sums up why reshoring manufacturing back to the U.S. is such a risky bet right now. Retailers and wholesalers saw their profit margins shrink by a record 1.6% in April. That means they're making less because they're absorbing higher costs instead of passing them on to customers, and it's not just a one-time thing. Since the start of 2023, U.S. retail profits have been slipping almost every other month, which is worrying, especially with inflation still stubbornly high. Businesses need profits to keep up with rising costs like higher wages and expensive raw materials. Take steel, for example. It's now 25% more expensive to import, but with consumers too weak to handle price hikes, companies can't just raise prices to cover those costs. This is a big reason why Trump's reshoring plan might fail. The uncertainties aren't just about trade wars or tariffs anymore. Now there's also the risk of higher taxes on foreign income and unpredictable policies. Even companies already operating in the U.S. are struggling to stay afloat, so who would want to take the gamble on building new factories here right now? So far this year, 246 large U.S. companies have declared bankruptcy, the highest number in 15 years. That's twice as many as during the same period in 2022. April alone saw 59 companies collapse. And the hardest hit sector, no surprise here, industrials and heavy manufacturing took the biggest hit. With this kind of chaos, what are the chances that big players like Toyota or other car manufacturers will bring production to the U.S.? Honestly, they're almost zero. The risks are just too high. Trump's biggest problem isn't the tariffs themselves, but the endless uncertainty. One day it's 10%, the next 30%, then suddenly maybe zero. And who knows what next month will bring. No company can plan or invest in that kind of unpredictable environment. On top of that, the U.S. dollar is weakening against major currencies, making the whole economic picture even more fragile. Trump is pushing Japan to bring production back to the U.S., but here's the catch. The dollar has dropped 8.1% against the yen. What does that mean for a foreign company? When they convert their U.S. profits back to yen, they take a serious hit. To make up for that loss, they'd need to charge American consumers 8.1% more. Shoppers already squeezed by high prices are now expected to pay even more. It's problems stacked on top of problem. Between a shrinking consumer base, unpredictable regulations, tax risks, and currency challenges, very few companies will rush to set up shop in the U.S. right now. We have to give credit to any company brave enough to take on this gamble because it truly is one. But here's the bullish side. With all this uncertainty, the companies that do take the leap will have huge opportunities to dominate. When others hesitate, bold moves win big. If you found this breakdown helpful, don't forget to like, share this video, and subscribe for more insights on the global economy and trade trends.